Welcome to Empowered Returns, a show that surfaces forward-thinking real estate advice that investors and developers need to help them invest smarter and build better.
Hello and welcome to another episode of Empowered Returns. I'm your host, PT Vineburgh, founding partner here at CHARLESGATE, and I am super pumped up to have Shant Banosian here from Guaranteed Rate, Executive Vice President, mega producer, loan officer extraordinaire. And
thanks for having me. This is awesome. Pumped to be here.
Psyched for you to be here. So let's get right to it, man.
Cool.
Everyone wants to know what the hell's going on in the mortgage world right now.
You know, it's been an interesting 18 months, right? You know, at the beginning of last year, early 2022, rates are humming along right at 3%. It was like 2 years of that. It was amazing. Free money, pretty much, or cheap money. And it created like this massive spending spree across pretty much everything. Houses, cars, the money was flowing all across our country on everything. And then, obviously it kind of turned into a little bit of inflation became a thing, right? And when inflation happens, rates go up. And so we've had rates pretty much double from early last year, starting almost about a year ago. Last June is kind of when rates really kind of jumped up into like the high 5s, 6s, and we even got up into the 7s at some point in October, November of 2022.
Yeah.
And we entered this year, in the 6s. Rates have kind of been hovering around. There's been a lot of challenges this year. We've had inflation kind of remain sticky. We've had this debt ceiling issue. We've had, we had the debt ceiling issue. We've had just, the banking crisis, Silicon Valley Bank, First Republic. So there's all this risk created, which is elevated rates. And so, money's gotten more expensive. What's amazing is people still buying homes, and there's still bidding wars and all that kind of stuff. But what's going on is I think we're at the end of it. I think we're pretty close. We're much closer to the end of this higher rate cycle. And I think we're going to kind of dip back into like my prediction is by the fall, we'll be in the 5s. I think rates will start coming down.
That soon? Okay.
Yeah. I think rates are going to come down. I think it's going to create a lot of optimism and excitement. It's going to create even more demand. We'll
get into the whole supply, demand, local dynamic stuff in a bit. But just kind of on a macro level, I think a lot of people were certainly going into 23 hoping that rates would start to come back down, and everyone's kind of saying Q3. Now a lot of people were saying now that's more into 24, but you think it's going to be more later this year?
Yeah. I mean, the reason people thought rates were going to come down, really kind of everybody had targeted like April, May is like, rates come down when inflation comes down, right? And inflation started to come down. Inflation peaked last year at 9%. Here we are like right around 4%, 4 to 5, depending on the the report you're reading. So rates should be, like if you look at technicals right now, based on where like the treasury bills, rates should be in the high 5s right now.
Yeah.
But all those other events that I kind of mentioned earlier kind of, created some uncertainty in the market. And so they're elevated. But I think we're going to start to see, we're on the other side of the Fed for the first time.
Right.
Didn't hike, just this past week.
Yeah.
So
Totally.
We'll see.
Again, everyone's so skewed, right? Because to your point, there was 3% basically free money for years, right? Like where in your mind is sort of that Mason-Dixon line on perception to really drive like consumer confidence? Is it 5? Like we need rates about 5? Is that? I mean, that's sort of the way I look
in the
at
5s.
it. Anything in the 5s.
Yeah, like I'll tell you, it was amazing when you saw rates start going up. Nobody was happy, right?
Right.
But there was 2 times last summer and then earlier at the beginning of this January, rates got back in the 5s. The amount of excitement that I saw from consumers and this spike in mortgage applications both times were huge. And then historically, before all this pandemic stuff, the market hummed along when we were in the 4s and 5s.
Totally.
Without anybody thinking twice.
I'm certainly, I still think I'm in my 20s, but I'm not.
Yeah.
And I remember clamoring to refi at 6.
Yeah.
Back in 03, 04, 05, that was great. And then in a historical context, 6 isn't terrible.
Yeah.
And to your point, I think 5s is sort of the magic number to really sort of get people off that rate fright train, for lack of a better cliche. Just made that up.
I like that. I'm going to use that,
dude.
I'm going to use that. I think you're right. Look, I think once it gets back down to that, you're going to see I think you'll see excitement. You're actually going to see a bunch of people be able to refinance, right? Yeah. And you're going to see a bunch of people just jump in and buy because, on the way up, things slow down. On the way down, there's so much excitement that's created,
right?
Because there's that little fear of missing out, and also fear, also the thought of getting a good deal.
Right.
So you just see massive excitement. So I think if we get back in the 5s, which I do think we're headed there, I actually even think there's a chance that we get back into the very high 4s if we end up into some recession,
right,
and the Fed actually starts cutting some rates. I don't think that's I think that's probably towards like the tail end of 2024 into 2025.
Yeah.
But I think we live next year in the 5s.
Yeah. Do you ever think we'll be in like the high 2s, 3% again in our
probably
in our professional lifetime?
Next pandemic.
Next pandemic.
Yeah.
Right.
So hopefully not.
Right.
Yeah. Hopefully not. Yeah.
All right. So look, we're kind of a new development focused podcast, right?
Yeah.
Let's talk about the importance of lending in new construction.
Sure.
Right. We can get into some other nuances, but just kind of generally speaking, from a developer standpoint as well as a consumer standpoint for the end buyer, like how important is it to have a good preferred lender? What are the advantages of having a preferred lender, and what are some of the the idiosyncrasies of new construction lending that are so important for the success of a project?
Yeah. No, I think it's super important. So it all starts with figuring out having loan products that can help the end consumers, right? So like, and where that starts is I don't think people when you get a mortgage on a condominium, you're as the lender, you have to come in and understand the condo docs, right? You have to understand the pre-sale requirements. You have to understand the master insurance, whether there's things like flood insurance involved on a big project, stuff like that, and you have to have the project meet as many investor guidelines as possible. So it starts, typically we come in and we'll approve the loan with like Fannie Mae and Freddie Mac. And that's like 90% of the mortgages out there. Right. Because a lot of even lenders that don't lend to those products follow their guidelines. So we try to make the project warrantable. And so we'll work with the developer and we'll review the condo docs in advance, review the budget in advance, help them with the questionnaire and answering all that stuff to, make sure that they're meeting all the guidelines and they understand the kind of checks and balances in place. So that's where we start. Then we figure out, to me, it's always dives into, when can you start lending on this project regarding pre-sale, right? So like a lot of lenders will not start lending on a project until something's like 50% pre-sold, in some cases even 70%. We have a lot of options where we can do, 30%, even no pre-sale requirements.
Yep.
We go out to the market and figure out, hey, we've got this project here, and we go to the different banks and credit unions that we work with and see if we can get this project approved with them. So we just try to cast a wide product set for all the different kinds of buyers that are going to come in. When you develop a project, you're going to lend to investors, you're going to lend to primary residents, first-time home buyers, all those, and they all have different needs, all different down payment requirements. So you just try to go out and find as much product that's going to meet that project as you can. And then I think the other part of it is like the communication with the developer, right? Like you have to have, it's obviously a sizable investment for them. They want to know that the money's going to come through if they accept somebody's offer. They want to know if they can count on the pre-approvals that are coming in so that they know when the units are actually going to close that are under agreement or under reservation. So there's that part. And what we typically do is we'll, every single week we'll give like an updated, do an update in terms of where we're at with every single unit that we're financing in terms of where they're at with application, appraisals, mortgage contingency, stuff like that. So that's one part of it. And the last part for the end consumer, obviously delivering on really, really great products to make the project as affordable as possible, right? And then the most challenging part is, extended rate locks and all that kind of stuff.
Timelines, delays. I mean,
they all happen. It's nobody's fault, right? It's like, especially over the last couple of years, it's supply chain and how busy everything is, and all the different challenges that we went through. So we have a wide variety of investors that will offer things like 6 months rate locks, 9 month, 1 year rate locks, stuff like that. Yeah. That just puts people's mind at ease. Obviously, a lot of consumers buying these projects, when they first started, the thought of buying, put something under reservation, maybe, rates were 2 and 3%, and now all of a sudden that's changed. And if they didn't have an extended rate lock, the cost to buy that same unit has gone up dramatically, and there's some stress and anxiety that's created from that.
Right.
So we try to avoid that, right? And so you're working with the developer, you're working with the consumer, you're trying to cast a wide net, and you're trying to create some sort of certainty that everything's going to actually close, because there's so many variables that happen over the course of a year.
Yeah. So let's talk about the perception versus the reality on down payment needs, and then sort of how that impacts the types of products that are available to you. I think, everybody kind of had that perception forever that you got to have 20% down. And then, after the whole subprime stuff, like, the pendulum swung back where people's, perception again was maybe that the requirements were actually more than they are. Yeah. And can you kind of speak to what's out there still for, especially in a market like ours that's so freaking expensive, right? Like, what options are out there for people that, don't want to put a ton of money down?
Yeah. The fact that you need 20% down couldn't be further from the truth, right? Like, it's like there's so many great products out there now. The great part is in the city of Boston and the surrounding areas where, you can get a conventional mortgage through Fannie Mae and Freddie Mac guidelines, which, cast the widest net up to about $828,000 here, right? You can literally put down as little as 5% down and finance up to 828. So like all those condos in the mid eights and high eights, like a lot of times you can put 5% down. Okay. And so, you can put as little as 3% down with like borrowing up to $726,000. So the bottom line is those are examples on Fannie Mae and Freddie Mac. There's FHA programs with as little as 3.5% down. Mass Housing offers great 3% down options for first-time homebuyers. VA allows, a lot of times we'll come in and get a condo VA approved, and they can put down as little as 0%, right? And those clients are different than they were years and years ago. I have VA clients that are buying condos for $1 million or houses for $1.5 million. So it's that people utilizing those benefits. And then there's also these great jumbo products and physicians loans that allow for 10% down or 5% down. So like, we cast a very, very wide net in terms of product set. And the thing is that, a lot of people do come in thinking they need to put down 20%. That's not the truth. Right. Investors generally have to put down like 15 or 20 or 25%.
Yeah, so that was going to be my next question. So thanks for kind of leading me there. What kind of investment? A lot of our audience are investors, right? They're either, people who are buying condos to rent out on the sort of small scale investment stuff, or, we have a lot of younger developers that tune in here that are looking to buy a 2 or 3 fam and, maybe rehab it and flip it, maybe go in and hold it long term. What is the climate like right now for investors? What's the delta on rate for a primary versus an investment property? Yeah. What are you seeing out there on that front?
Yeah. So, the delta on rate surprisingly is not that big right now between primary investment. It's actually about, it's historically it's somewhere between like a half point and a point higher. Yeah. The one thing that has changed dramatically in the last just year that a lot of people don't realize is that, we were in this low rate environment and there wasn't really the thought of rates spiking up as fast as they did. Yeah. And obviously that happened. So the way we've seen the secondary market reprice is that they're still offering really competitive rates to the investors, but now that you're seeing a lot of cases where they require like to pay upfront points, which was kind of not a thing for a while on investment properties. But that's like, we have a lot of investment products that require a point or 2 points, like which is just upfront closing costs that you have to pay in order to secure a mortgage. Yeah. So that's been a big change. It's probably the most predominant it's been in my career over the course of the last 20 years. Okay. And then in terms of down payments, you're looking at same deal, 20, 25% down. There's still an appetite out there. There hasn't been, a pullback in terms of product offerings for investors. If anything, that stuff's opened up even a little bit more now over the course of last year. You've seen a lot of new products come up for investors, things that will, that you can utilize bank statement loans. You can utilize like a lot more opportunities when somebody's buying something in an LLC. Some of that stuff wasn't available for a long time. Mm-hmm. So you're seeing, and a lot of times developers, are self-employed, the way they show their income is based off capital gains, stuff like that can be harder to kind of blend on. And you're starting to see a lot of the residential products feel and look a lot more like commercial products, again, like some make sense lending options. So that's been a huge positive. Okay. Unfortunately, the rates are higher, right?
Yeah. Totally.
But like, it's opened up a lot of opportunity for developers.
Yeah. And what about on like equity lines and stuff? Because obviously so much of the investor segment of the market for years was utilizing, in the rates of appreciation we had in our market, we're pulling money out of, assets that they own to go buy more assets. And what are you seeing as far as like LTVs, rates, and on the equity side to try to arbitrage and get more, expand your portfolio? Yeah, the
average rate on a home equity line right now is like 9.5%. Yeah. So that's gone up a little bit. Yeah.
Like a credit card.
Yeah, credit cards average rate's 20% right now.
Is it really?
Yeah, the average credit card in the country right now, the average interest rate's almost 20%.
Holy smokes.
It's a lot. It's like that's like what Tony Soprano used to rent money at.
Yeah.
But it's that's just what it is when the Fed raises rates. So lines of credit are still super popular. interestingly enough, the average American today has about 52% equity in their homes, right? It's a huge
pretty
number.
Good. Yeah.
It's the most it's ever been.
That's more than I would have thought.
Yeah. So, and literally just saw the stats come out last week. And so, so the home equity lines are super popular, probably more popular than they've ever been because the equity's there. And then on top of that, a lot of people don't want to touch their first mortgages, do like cash out refis and stuff like that. Yeah. So they're utilizing the equity lines.
Right.
So still super popular. I think, that's like one of the most, to your point, like that's where I see a lot of people tapping their cash in terms of other assets, right?
Right.
And so there hasn't been a freeze on that. If you remember during the pandemic when that first happened, it was really hard to get a home equity line.
Yeah.
That is not the case right now. It's pretty easy to get. Have you seen LTVs go up to 80, 90? Okay. Pretty standard across the board. Now, those are on primary residence. You can even find home equity lines available on investment properties, fewer and far between, but you can still go get those type of products.
Yeah. So I think that that 80, 90% you just mentioned is obviously sort of indicative of, values, clearly, right?
Yeah.
And banks' confidence in values. So I think at least locally, right? So that's a good segue. Let's talk about our local market, right? And just sort of how different it is. What are the dynamics here that just drive it? And, from your standpoint on lending, why candidly it's probably a little easier to borrow here than certain other places, right?
Yeah, I mean, look, I fortunately I have a pretty good view because I'm licensed in all 50 states.
Yeah,
I do business all around the country, and I can tell you what's going on the East Coast is a lot different than what's going on the West Coast right now.
Okay,
and especially in the Northeast. Like the Northeast is the hottest real estate market in the country right now. Even like New York's just as hot as Boston, right? And it's like, and it wasn't for a while, right? But what's going on here? Obviously, our challenge is that inventory has always been a big challenge, right? Yeah, it's like even in 2008, right? Like when the whole world got rocked real estate wise, you had markets like Cambridge and Brookline and like the South End and all these places that like either didn't lose any value or had some single digit appreciation, believe it or not.
Right,
the rest of the country was down like 20% or 30%.
Yeah, of course.
But so we've got obviously. The job sector here is very strong with tech, biotech, obviously booming here, and finance, right? And the universities and schools and even our public school system here is just like amazing compared to like other parts of the country. So it draws people from all over the world. Like Boston's really turned into like, it's not just like it maybe not what it was 20 years ago. Like the amount of people that are coming here to work here from all over the world is like, I'm just blown away. Even over the last couple of years when like the remote work had gotten so popular, people are still moving here to kind of work in some of the sectors here. So, what I'm seeing, obviously, it's the highest part of the country. It's got the most over asking bids, so bidding wars, right? The fastest closings in the country are happening, here. And that was the case. That was no different in 2020 and 2021. Like if you looked at like the top 5 hottest markets in the country, Boston was either like 2 or 3 or 4 during COVID.
Yeah.
So that stayed the case. Like, so I mean, the income, you got a lot of 2-income households here, right? That are super, super strong. You've got, and a limited supply of inventory and demographics that are like just the buyer pool here is very, very big. And everybody wants to get into housing because, they're confident that it will continue to appreciate over the course of time. Lending wise, to your point, like, we have a lot of product options here for a relatively small amount of geography, right? Like Boston's so small.
It's crazy small.
Yeah. So I don't see the demand here changing, and I don't see inventory increasing. One of the biggest challenges we have here is how hard it is for new construction to happen.
Yeah, you just can't. You can't move the inventory needle, right? And the demand, to your point, has so many fundamental drivers that it just the imbalance is just it's going to be in perpetuity unless
there's not enough new construction that's going to happen that's ever going to fill that need. So why that's good, if you get into the market, you're kind of always protected. Like your home, generally speaking, if you get a fair price for it when you buy it or whatever you deem fair, right. is going to likely go up 5-6% on a yearly basis. I don't see what's going to cause the demand to slow down, and I don't see what's going to create the inventory to all of a sudden magically be enough. Like we've got 2 months worth of supply of housing in the Boston area right now, maybe even slightly under 2%, 2 months right now. And you need a balanced market's considered 6 to 7 months.
7 months, right? Yeah. All right. So I want to shift gears a little bit.
Yeah.
I'm going to pump your tires now, right? Okay. So if you were getting bored, you better start listening because Shant Banosian has been the #1 mortgage broker in America for 5 straight years.
Yeah.
Right. So you know what you're doing.
Yes.
And that's incredible accomplishment.
Thank you very much.
Just awesome, and humble, and a great dude. So that makes it a lot easier to chat with you.
Yeah.
So did you how long have you been a mortgage broker?
It's all I've ever done.
Okay.
I literally since I graduated from Bentley when it was Bentley College. I graduated in 2002, and so I've been at this literally exactly 20 years now, 21 years.
Could you have imagined that you'd be where you are?
Look, I kind of fell into this business totally by accident. But it's funny. I literally opened up my first company in 2008 when stuff was really bad.
Right.
And I was literally just looking to survive. I was I think I can make a career out of this. But I will tell you, about 4 or 5 years in, I knew that I could change it, what was expected of a loan officer. I saw that there was an opportunity to build a team, deliver better service, utilize technology. And I was fortunate. I was surrounded by, I was lucky early enough to meet some people that were having a high level of success, both in the real estate world and in the mortgage world.
Yeah.
And I was able to see gaps in terms of service and tech in our business that I was able to kind of just go after and fill. And I had big vision, big dreams. And then I just worked really, really hard, man.
Yeah,
I gave it everything I had.
Right.
I still do.
Yeah.
But
but you got, pretty solid tan.
Yeah.
You're still working as hard as you used to.
I work pretty hard.
Yeah.
I have good Armenian skin here, so it takes that sun in. However,
the gyrish is this is no bueno.
Yeah. No, you know what? It's I have a really amazing team now.
Yeah.
Back then I was by myself, right?
Okay.
Now I've got 35 team members.
Okay, that was my next question. Yeah. So you just keep knocking them down here. 35.
Yeah.
Wow.
So look, my thing is this, I want to work on my business. I want to be the visionary. I want to be the business development person. I want to be the rainmaker. But I have these amazing people around me that handle marketing, branding, operations, sales. We've built a real company within the company, right?
Yeah.
And so it allows us to just keep kind of focused on taking on new initiatives, taking on new relationships. Like I said, when I opened up my business, I just wanted to be the mortgage guy in Watertown, Waltham, and Belmont, right? And then when I got Cambridge, Somerville, and Southie going, I was really happy. Now we're licensed in all 50 states and doing business all around the country pretty consistently. And so it's pretty humbling, right? It's wow. It's how did this happen in a relatively short amount of time? But it's because I've I really believe in the team approach and just surrounding myself with really smart people.
Yeah.
And there's only so much you can do by yourself. I would not be here right now if it wasn't for the amazing people on my team.
Yeah. Okay. Cool. Now, do you invest in real estate yourself?
I do. Yeah, I do.
So what do you look for when you're investing in real estate?
So I've done all sorts of stuff. Most of the stuff my personal real estate holdings, Watertown, Belmont, Cambridge, the markets that I know, and I do multifamilies. I kind of grew up with that old school mentality around me. So it's it's easy. It's what I know. I look for cash flow. I look for it's easy for me. But I've also done some commercial deals, some bigger developments. I've invested in projects in Nantucket and the Vineyard and something in Miami right now. So as I've met new people, I've been able to kind of expand my horizons. What I look for, honestly, when it's not like a multi or something like that, I just really look for really smart people that know I'm betting on that developer or the investment team as opposed to more than anything else, their track record, their vision, the opportunities they're finding. It's not so much about the property at that point. It's about that person.
Yeah. Okay. All right. So I'm kind of start winding it down here. Yeah. How do you stay kind of on trend with everything that's happening in your industry? What are you digesting for news sources and how are you staying ahead of the curve on everything in the lending?
I think it's so important. I'm all I do local market. I'm constantly talking to the who's who in the business in terms I just there's only I respect the people that are doing business in these markets and all different, whether it's residential, commercial, development, all that kind of stuff. I'm just constantly talking to people. But then I'm also I read all day long, whether it's bigger publications like Housing Wire and Inman and stuff, or Zillow, and checking out the Redfin reports, or the Journal, the Globe. I'm constantly just consuming information. Then I'm following smart people on things like Twitter and Instagram, and I go to conferences all over the country. I'm constantly just taking information in because it's so important. If you're not staying up to date with trends, you're falling behind.
Right.
And the world changes faster than ever before.
Yeah.
So I'm all in on like being, I take it pretty seriously. So like I spend a huge portion of my day just like consuming information.
Okay. So you're a big reader?
Yeah, huge. Every single day.
Yeah. What, any like really good books you've read lately that you would recommend?
Man, what's funny? I've two great books I've read. I'm big into Ryan Holiday right now. So he's got a bunch of great books. Discipline is Destiny. The Obstacle is the Way. I thought those were good things, like in a tougher market to get honed in on. One of the best books I read this year was The Gap versus the Gain, which is like a mindset book. Who Not How was another same kind of author. So like I'm probably taking down a book like every 2 weeks. I'm a big reader.
Okay.
Those are just like the ones that come to mind. But I could go on and on. We could do a
too bad DeMella's not here. You guys could geek out on books.
Yeah, I'm a huge reader, man.
All right, that's awesome.
Yeah.
Bigger meltdown, Seltzer Bees.
Oh, I think the Bees.
Yeah.
They were so good. They're the best team in hockey, and the Bees. I was at Game 7 when they lost. I took my kids, and they couldn't even figure out how. They didn't even think it was an option that they were going to lose, right?
Dude.
And I had to explain to them that that's how it goes. The Bees were a bigger meltdown for sure. The C's were I kind of wasn't surprised they didn't pull it off. There was something about that team that, but the Bees were they had it everything this year. They were tough. They were fun.
Deep. They had from the goalies out. That was crushing.
Yeah,
that was crushing. I was on a plane on the way back from Toronto when Game 7 was going on.
How great would it be if we were in Vegas last week, watching the Bees beat the Knights in the Stanley Cup?
That would have been a good storyline too. Yeah. And look, hats off to Florida, right? Yeah. They went on a great run.
Yeah.
And it's interesting that I was
happy for
Trophy
Bruce Cassidy, though.
Man.
I was happy for Cassidy.
Yeah,
and a little bit it was cool, good redemption story. I'm a big redemption person, and cool for him to kind of go somewhere else. After taking some lumps here and winning, so good for him.
Yeah, no, totally,
yeah,
totally. That was a tough spring.
Yeah,
but at least we have the Sox.
No,
we don't have the Sox.
We got the Pats. Hopefully we'll sign DeAndre Hopkins here.
That would be nice. That would be nice.
It'd be really cool. Yeah.
Yeah. All right. Anything else you want to share with our audience, or
no, man? I think this is awesome. We touch on a lot of stuff in a relatively short amount of time. So I think we got a good run in front of us in terms of real estate world. I would say, for all the developers out there, if this is a developer heavy show as it is, keep building, right?
Totally.
There's such a need for great quality product, and what it does for our communities in terms of revitalization, reinvestment in the communities. It's so important, and people want it.
Yeah, and look, to your point that was made earlier, right? It's so hard right now in the political climate we're in to entitle new projects, and obviously with the cost of money and construction costs, it's if you have a shovel-ready condo project in a decent area, and especially if you've got the balance sheet and ability to capitalize that internally, or you can get better than most people could get in terms from a lender on the debt side, build it.
Yeah,
right. There's such a demand right now for our market. Yeah. And there's just such a thin pipeline, I think, for the next, really 12 to almost 36 months on the for sale side.
Yeah.
And then go get your buyers to get their loans with Shant Banosian.
There you go. Yeah, we'll approve that project. Let's go.
Right?
Yeah.
All right. Well, Shant Banosian, pleasure to have you here.
Thank you.
Congrats on all your success. And I really appreciate you dropping the knowledge and bringing the insight to our audience. So
that's great.
We will catch you next time on another episode of Empowered Returns.
Thank you for listening to another episode of Empowered Returns. If you're a forward-thinking real estate investor or developer looking for actionable advice that will help you generate market-beating returns, make sure to subscribe on Apple Podcasts, Spotify, or wherever you get your podcast fix. I'm Mike DeMella with CHARLESGATE, and I'd love to connect on LinkedIn and further the conversation for any specific questions you may have. Thank you for listening.